The failure of the US-based Silicon Valley Bank, SVB, the biggest since the 2008 financial crisis, is the story of a business model that no longer works. One based on zero interest rates, the illusion that money no longer had a cost, and that the tech sector would forever remain a golden goose. But central banks raised rates to counter inflation, the tech bubble burst, and SVB couldn't handle it, forcing the US government to deploy shields to stem the contagion effect. Silicon Valley Bank is an exquisitely Californian institution. Founded in Santa Clara in 1983, it had become the bank of choice for American tech companies and venture capitalists. It was growing rapidly, abetted by the industry boom, and by 2021 was managing about half of all funds used to finance startups. And therein lies the first weakness: a single type of client, a single industry, a single geographic district. The second weakness is also related to the nature of SVB. Basically, banks have to deploy depositors' money. A traditional bank uses it primarily to lend to its customers, but the startup funding model rests on venture capital, not bank loans. A startup bank, therefore, not knowing what to do with the cash it raises, invests mainly in government bonds. By the end of 2022, Silicon Valley Bank had nearly $100 billion in government bonds on its assets. No complications until the Federal Reserve, the US central bank, kicked off interest rate hikes. The startup ecosystem thrives in a zero-interest rate environment. When interest rates are low or zero, a dollar today is worth as much as a dollar 20 years from now. An ideal prospect for a business model that relies on future earnings while tolerating even large losses in the present. But the world of non-existent rates was not forever. With the onset of monetary tightening by the Fed, startups took a jolt. A dollar today had become more attractive than a dollar 20 years from now, and venture capital investments dropped dramatically, as did valuations. To keep growing, startups therefore began burning cash and withdrawing their deposits. And Silicon Valley Bank, with such a specialized customer base, has found itself facing increasingly frequent withdrawals. To these outflows must be added the effect of rising rates on SVB's assets. Most banks, when rates go up, yes, they have to pay interest on deposits, but they also get higher returns from loans. Silicon Valley Bank, however, had few loans and many long-dated government bonds on its books, and the cost of paying interest on deposits had increased more than the yield it could receive. In essence, it was losing money. SVB could have waited until the natural maturity of the bonds, but startups were withdrawing deposits and did not have a sufficient liquidity cushion. Hence the episode that triggered the crisis of confidence in recent days. The sale of $21 billion in bonds, a sale that generated a loss, because when interest rates rise, bond prices fall. The announcement of the losses sowed panic among venture capital funds, which pushed member companies to collect their money. By the end of the day on Thursday, March 9th, $42 billion in deposits had flowed out, a classic run on the counter. Thus an entire business ecosystem, typically American, bolted in on itself as it was erected on the prospect that rates would remain at zero. Federal authorities, to avert a snowball effect, have put in place a life-saving intervention for depositors. Indeed, the Treasury, through an interbank fund, has pledged to guarantee the full amount of deposits of SVB and Signature Bank, another institution closed by the government. Guarantees that go well beyond the $250,000 covered by law. After all, almost all deposits exceeded this threshold and were in danger of dissolving. Not exactly a bazooka, however, since shareholders, unlike current account holders, will lose their investments. Meanwhile, the Federal Deposit Insurance Agency proceeds to sell SVB's assets. Also taking action to restore confidence in the banking system is the Federal Reserve, which has made available $25 billion for a new loan program reserved for troubled banks. The move is meant to prevent hasty sales of securities that, as in SVB's case, create capital holes. It remains to be seen whether the U.S. central bank will also slow down the pace of rate hikes, given the severe turbulence in the markets. Most analysts believe that at next week's meeting, rates will remain unchanged or at most go up by 0.25%, when until yesterday, a further 0.50% hike was expected. A balancing of risks between inflation and financial stability the Fed will have to consider. If nothing else, the SVB case has shown that in spite of how well economies are holding up, rate hikes have important side effects. As far as Europe is concerned, regulation of the banking system is stricter than in the US. However, news from the US has added up, and factors of concern have added up, such as the situation at Credit Suisse, Switzerland's second-largest bank. Credit Suisse has years of scandals and accounts in the red behind it. Therefore, its problems go back well before the recent turmoil in the markets. However, the latest events and fears of contagion from the US have accelerated its crisis. It is news these hours that the bank will be bought by UBS, Switzerland's leading bank and its historic rival. That's it for today, guys. We'll see you in an upcoming All in Finance video.